Well guys, the stock market has officially flipped. We've just witnessed the best day the S&P 500 has seen since March of 2020, giving long-term investors a glimmer of what the next bull market could actually look like. And this is obviously as a result of the CPI inflation report, which came in much lower than most analysts had expected as the recessionary fears and layoffs start to hit the job market and people are forced to spend less and less money. Now, if you've been following my channel for the past few months, this was not that hard to see coming because if you focus on the leading indicators of inflation, it's easy to see how things are slowly rolling over, even if some CPI misses tend to happen over the past few months. And well, this has resulted in a stock market rally that absolutely no one expected at a time when actually most stocks were falling to their new 52-week lows. And so now the question on everybody's mind is this just another bear market rally, or is there substance to this massive move we're seeing in equities? And spoiler alert, the bull thesis has just improved dramatically. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, let's understand why the CPI actually came in lower than most analysts had expected, and what does this mean for the Federal Reserve on their interest rate hike. The headline CPI print came in at 7.5% compared to estimates of 7.7%, with the core coming in even lower at 6.3% versus 6.5%. And obviously, the reason why this is such a big deal is because inflation has been a headache for the market ever since the start of 2021, which is when most growth stocks and speculative companies got absolutely destroyed as investors were trying to price in a higher 10-year yield, which would obviously discount a lot of the future cash flows of those then unprofitable companies. And then in the end of 2021 is when the pain for the rest of the market really started to come as we hit the bear market of 2022, when inflation hit a peak of around 9% in June. And yes, even though the CPI prints for August and September were not really that great, it was not really that much of a surprise to expect a lower CPI for November and December like we just got based on the month-over-month change in inflation. The simple fact of the matter is that if you look at leading indicators like real estate, crude oil prices, and consumer spending, inflation is probably going to start coming down. And we all know that interest rate hikes take time to get factored into the economy and start reflecting into CPI, because obviously we only started hiking at the start of this year. And when you have the used car and truck market collapse from its peak of around 40 to 50% year-over-year growth to around 2%, you should expect people to cut down their spending as all of a sudden they can't make money on their cars and even their real estate, as the 10-year yield has obviously skyrocketed since June. And the thing that people don't understand is that real estate is not only the biggest proponent of wealth for most people, but it is also the slowest mover as a result. Meaning, even though real estate prices are starting to slowly coming down, they're not going to be reflected in the core PCE or the CPI data for maybe another 4 to 6 months. And instead, you want to look at leading indicators. And as you can see, the month-over-month change in national rent has already collapsed for the past 2 months, and it is now hitting the lowest level since 2018. And guess what the biggest component of CPI is? It is indeed shelter. A 6.9% year-over-year increase in the shelter component of CPI resulted in the overall CPI being pushed up by 40%. That is almost a 4x leverage that one single component has in the entire headline CPI. Meanwhile, all the other components like apparel, dining, and even prescription drugs actually declined year over year. So a lot of the stuff that people are spending money on durable goods are coming down, but the slow movers like real estate and even used car prices are taking their time. All the other components outside of shelter are already starting to see year-over-year declines, which is obviously something we were not seeing around 4 months ago. Guess what? As slowly real estate comes down, layoffs hit the market, and people have less and less savings, consumer sentiment also ended up weakening in November for the first time in a few months. And guess what? When stimulus checks were handed out left, right, and center back in 2021, it was consumer spending that went up and caused all the supply chain problems and inflation mayhems that we've experienced here in 2021 and 2022. And so now that that index is starting to come down, it's again a leading sign of where inflation could be headed within the next year. And even if you want to look at real data from the Federal Reserve about how they have adjusted to the money supply problem, as you can see year over year, the M2 has actually collapsed and come back down to pre-pandemic levels. And as you can clearly see, M2 always tends to lag CPI by around 6 months, meaning yet again that a lot of the inflation and money printing has been stopped and we have come back down to pre-pandemic levels. Naturally, CPI should start following this M2 change sooner rather than later. And although I don't expect the Fed to pivot anytime soon or hit a more dovish tone, I do expect them to understand that their rate hikes work with a major lag, meaning their terminal rate for the end of the year could be adjusted to either 4.75 or 5%, which is obviously about 100 basis points higher than the current rate. And the honest reality is that with the rental market already starting to cool off, their heightened interest rates might already be too strong for the current decline we're seeing in the economy, meaning they might put us into a stronger recession than we would have initially needed if the Fed just had done nothing. And that's basically what the Fed is doing. They're playing catch up. So you cannot use what the Fed is doing to judge or time when the market will actually bottom. As you can see, the VIX has actually been collapsing for the past 3 months, even though the market has actually been continuing to go down. And you guys already know my take. I continue to dollar cost average into all my investments and my stocks, regardless of what the market does. And the reality is that if you wait for this recession to be over or for the Fed to pivot before you try to buy stocks, then you are missing the whole point of investing. Every single bottom we have seen over the past 40 to 50 years occurred in the middle of a recession. And by the time that the recession gets announced, the market has likely already bottomed. And we all know right now the Biden administration is not announcing this recession. And they're not going to do that until at least the summer of 2023. And by the time that happens, most folks will be way too late to buying the dip if the current inflation trend continues. And with so many retail investors flocking into puts left, right, and center with no regard for risk, it shows you that most of the crowd is on the wrong side of the trade, just like they were with GameStop and AMC in early 2021. Back then, the market was continuing to go higher every single week, and most people just bought calls and bought stock and did not care about any of the risk. But now all of a sudden, all retail investors have become these macroeconomic experts where they can now predict what the Fed is doing. And the simple reality is so much of the narrative is common amongst all these arguers, meaning there is no edge in following any single one of them. And on a historical basis, 2022 is a record year. The 10-year Treasury has never seen 15% declines within a year. This is an event that we're probably never going to witness again in our lifetime. Meaning as an investor, you're probably getting one of the best risk to rewards in the stock market right now. And waiting until the Fed pivots is most likely going to be way too late because every single investor in the market is waiting for that pivot to happen. So people are instead going to look at leading indicators to try to time the bottom, which is obviously something most people fail at doing. And guess what? Even if your companies are reporting poor earnings in the short term, it does not mean the bear market has more room to go to the downside. On average, it has been proven that the stock market bottoms 6 months before earnings do, because obviously most people are panic selling at a time when a lot of that stuff has already been priced into the valuation. And so the early buy the dippers are the ones that end up really making the big money in this kind of drawdown. And waiting for the inflation number to fall to 2% or for earnings to actually become positive is going to be way too late if you want to try to time the bottom of the market. Historically, dollar cost averaging is going to be the best bet you have if you're buying companies that you have high conviction in. And as for whether or not this is still a bear market rally, on a technical basis, yeah, it is, because we're still in a bear market on the NASDAQ. If you're anything below 20%, you're still technically in a bear market. So any market rally underneath that 20% threshold is technically going to be considered a bear market rally. So I simply do not understand why people are using that as a metric to judge whether or not the market has actually bottomed. Instead, you should be thinking of these rallies as an opportunity to either de-risk on your investments that you have lost confidence in or to continue to hold and dollar cost average in, because guess what? We are still down around 30% from all-time highs on the NASDAQ. And with so many tech companies already laying off thousands of employees at a time, you're gonna start seeing consumer spending hit hard, and these recessionary fears only get amplified over the next few quarters, which will again amplify the risk to reward for your investment. Because it's the tech industry that fulfills these big salaries for some of the top 1% in America, and those folks at the end of the day are the ones that are buying expensive devices and equipment, which again is what's feeding inflation like real estate and autos. And even though many people think that the Fed's QT is still yet to come, the Fed has actually been unwinding their balance sheet considerably for the past few months. And as we all know, in the long term, the Fed does not need to unwind their entire balance sheet to bring inflation down, because obviously M2 money supply has already collapsed. And that money supply is simply driven by the 10-year Treasury, which is already a part of the QT process. But anyways guys, that is just my take on the situation, so let me know your thoughts down in the comment section below.